Hi, I'm Midas of Midas Investing, and today we're going to be taking a look at ticker IFSPF, Interfor Forest, Canadian lumber producer, pure play lumber producer, which we've covered here on the channel before, and is also a holding currently in my own portfolio, just full disclosure. If you enjoy valuations like this, please like the video to help us with the algorithm, and subscribe to the channel, that way you get notifications whenever I go live, and join the Discord, the link is in the description below. All right, and with this valuation, we're actually going to dive pretty deeply into the investor presentation that they released with their fourth quarter earnings very recently. I found this presentation to have lots of useful information, both explaining Interfor's position within the overall lumber industry, as well as giving a good overview of what we can expect from them moving forward and into the future. One of these first slides right here that they have in the presentation, they show a few different metrics, which I think are very interesting. Firstly, we have this adjusted EBITDA margin per unit, which they display in Canadian dollars per million board feet, which is a metric for lumber and how it's usually measured within the industry. But they're basically just showing how their overall amount of gross profit they were able to get on attribution for each amount of lumber sold in their business skyrocketed in the last 3 years, putting it well above the longer 10-year average, and then also puts them pretty attractive relative to their competitors as well. But what I wanted to call attention to is actually the way those margins used to be in the past. And we're going to, obviously be talking about lumber prices and like where we think lumber prices are likely to go relative to where they've been in the recent past. So thinking about like how this immediately translated into direct profit attribution for the company in the last few years. We'll take a look at that in terms of like the gross margins versus their operating margins. But if you look at it in percentage terms, you can basically just say that the high profitability that they had in the last few years came directly from excess pricing in lumber, which is where the extra profit came from, not from operating efficiencies or anything like that. And then this slide over here, they also talk about their lumber production over the last decade, which has grown pretty dramatically. Obviously, that's going to be a big major part of the discussion as well, not just lumber prices, because effectively speaking, lumber prices plus the overall production of the company is going to get us roughly towards our revenue projections for the company. And then they talk about how the production itself has grown in terms of a per share measure, which is a pretty interesting metric to kind of think about, a per share production in terms of for like a commodity company. That's kind of a neat way to think about it. And then they're also displaying their price to book multiple and seeing how over time that's actually kind of trailed downward, particularly in the last year. Though, like we've kind of said, that probably has largely to do with the lumber prices and the uncertainty relative to them. Here they show themselves off as a largely pure play lumber producer, particularly compared to some of the other larger competitors that they have: West Fraser, Canfor, Resolute, Potlatch, Deltic, and Weyerhaeuser. They see themselves primarily as a pure play comparative to also having like pulp and paper products, engineering wood panels, timberlands, and things like that, as they say. Though this, in this little note, they should say it on here, technically speaking, this doesn't include small amounts of their e-com acquisition, which they just completed. That technically gives them a little bit more diversification beyond that. But either way, very, very focused on pure lumber production. And in terms of the scale of that production, you can see where they are now positioned versus the other large players within the North American lumber space, being third basically only to West Fraser and Weyerhaeuser. Now, focusing a little bit more closely on the geographic distribution of their production, you can see they were historically very much focused on like the British Columbia interior kind of focus space, which is a largely mature and developed lumber region, as well as Eastern Canada. I mean, they are obviously a Canadian focused company, but within the last few years, they've particularly been branching out very, very heavily into the US South. As you can see right here, about 2.3 million board feet, billion board feet, about 45% of the overall production of their company now in the U.S. Southeast, which is a pretty good geographic diversification across the various lumber regions in North America. Focusing in specifically on lumber itself, they have this slide here showing the decline in lumber prices within the last year and a half or so since the high peaks we saw in 2021. They're calling it an attractive level, historically attractive prices, and saying that it's finding support there. As I said, we'll get into my projections for lumber prices specifically, but it is interesting to see some of the notes they have about the lumber demand and how that's affecting the prices. And what, for example, right here, they disaggregate the demand by specific subsections, and you can see that while there is sort of a leveling up in the overall demand in the last few years, and technically it peaked back in 2018, 2019 kind of time frame, and it's been a little bit lower since then. You can also see that the offshore exports portion of it has been slowly disappearing. You might argue that has to do with higher tariff levels between North America and the rest of the world in the last few years or so, with kind of like the ramping up of some trade disputes. So it's possible that with that starting to disappear, because obviously it can't go more than disappear, then that might start to level off. And you can see that the other subsections, domestic residential, industrial commercial, and residential repair, are actually remaining relatively strong and healthy comparative to that section that seems to be disappearing. And then focusing in on like where the source of this demand actually comes from. This is kind of like a metric that we see a lot of talk about within various industries that are related to real estate, or particularly the residential real estate market. There's lots of talks about the US housing starts being particularly behind ever since the previous housing crash back in 2008, 2009. There was basically a lack of overall building for many years that hasn't been managed to catch up with the levels that were expected. And not to mention, there's been a largely growing age within the U.S. housing stock. Here it shows the median age in years of the U.S. housing stock, which has been growing and growing over the last couple decades. And at some point or another, that means that more and more repairs have to happen to all of the existing homes, or the homes have to be replaced, which creates just an underlying strong trend for the lumber space in particular. And then focusing in on these next two slides, which I think are really important. This slide right here shows their production over the last decade or so, how it's grown pretty dramatically up through 2022, about 11% CAGR as they're calculating it. And they also have further production gains that they are expecting. What with 2023, they're expecting to get up to 4.5 billion board feet with the Ecom and Schuler acquisitions that they've completed at the end of the last year. Not to mention, they have further projects that they have in the pipeline, which gets them to an expected 5.1 billion board feet in 2025 with the planned capexes that they already have. Not to mention, there's further projects in the pipeline that they have that are a little bit less solid and not quite locked in, but with lots of opportunities in front of them, they feel reasonably confident that they can secure at least enough of those projects to get them up to the 7 billion board feet by their target of 2027. We're definitely going to be relying on these kind of production targets, both the 2023 4.5, the 2025 5.1, and the 2027 7 billion board feet as our production targets moving into the future. We're probably going to give them a little bit more of a runway for that, because obviously we're doing a 10-year projections, and we don't want to make any bold predictions about what they'll do beyond that. You'll see what I mean here relatively shortly. And my confidence with their ability to actually achieve these targets comes partially from this slide that they have right here, showing the overall disaggregation of the lumber market. It's very fragmented, as they show right here. The share of the top 30 North American producers is only up to about 2/3. 30 players maintaining about 2/3 of the space, which means there's going to be many more in that last third there. But the point is many other markets, the top 2/3 of the market might be down to maybe like 10 players, 5 players, depending on how concentrated an industry is. So with that many producers within the space, that gives lots of opportunities for assets to be traded back and forth. Then they also show the number of deals that have happened over the last decade or so, and you can see the vast majority of them have happened in this southern region, which is where they were saying the largest amount of growth prospects exist for them. So I feel reasonably confident that they can probably hit those production targets, if not more, going into the future. All right, now let's hop into my financial statements for Interfor real briefly. And as I do that, I want to ask once more for people to like the video, also subscribe to the channel if you haven't already. So coming in right here, take a look at their gross margins in particular, something I really want to focus on. As we were kind of talking about within the presentation, the large gap up in their EBITDA margin per board feet that they've sold. You can see that very cleanly in the margins as they've shifted over time. What with, for example, the average gross margin that they had prior to 2020 was about 13.5%. And the average gross margins that they've had since then has been 31.6%. So that's about an 18% jump up in the gross margins over the last 3 years relative to the 7-year average that they had during that time frame. And then you can compare that also with the adjusted operating margins that they have for the company within the same time frame. They had an average adjusted operating margin of about 4%, versus the average adjusted operating margin of the last 3 years has been almost 25%. So you can see that's about a 21% difference. So 18% difference in the gross margins, 21% difference in the adjusted operating margins. You see the vast majority of that change effectively came from the gross margins, which goes to show that basically that means it's a little bit of a double-edged sword. It means that with normalization in lumber prices that we can expect moving forward, that means that all of that excess revenue would disappear and all of that gross margin would disappear. But that also means that it's not locked to particular operating costs that are relatively leveraged and harder to undo. So that means easy comes, easy go, so to speak, when it comes to that profitability. It will evaporate, but it should evaporate in such a way that it's not going to leave them in a net negative margin type scenario on an operating margin basis, or at least that's what I would expect. We can also then compare this with the industrial expectations that we have with my industry data set that I have right here, comparing them with the gross margins of the industry. You'll see the industry gross margins for the last 5 years has been 22.6%, which is the longest time frame that we have going back for them, or versus 26% in the last 3 years on average. If we compare that versus the gross margins for them, as we were just saying, 26% versus 32% for the last 3 years, that shows that their gross margins have actually been stronger than the industry in the last 3 years. Over the last 5 years, 24.2%, and we were seeing also about 26% for the industry. So while their margins are expected to drop back down pretty dramatically, we can still perhaps expect them to be a little bit stronger than their industry as a whole. While we're also over here on the industrial data tool worksheet that I have right here, we can also take a look at the adjusted operating margins for the industry, which over the last 8 years has been about 9.2%. Coming back over to the financial statements for Interfor specifically and looking at those last 8 years to get ourselves an apples and apples comparison, to see that they themselves had a 12% margin, showing that even over this longer stretch at an operating margin level, they were stronger than their industry as a whole, with lots of variability, a couple of negative years in the mix there. While we're still looking at this, I'll also focus on that. The adjusted unlevered beta that I'm using for the industry has been 1.04. That's going to be relevant for our cost of capital calculation. And also while we're here as well, the sales to capital ratio for the industry for the last 8 years on average has been about 2, which means that there's about $2 of revenue in the industry for each dollar of capital invested, approximately speaking. Now coming over to the cash flow financial statements, there's a couple of things that I want to point out here that are interesting and of note for Interfor. One thing is that if we focus specifically on this component of cash from operations graph, you can see another way of kind of exemplifying what I was showing about the gross margins, but more on a net income basis. You can see the huge jump up in net income as a whole, but without really that much of a large change in the change in working capital component of the cash flow from operations. That shows that this larger amount of cash flow from operations is not coming at the expense of changes in overall capital structure in the business, which means that as that net income disappears, we're not going to have it flip to the other side and have negative cash flows as the company has to make up lost ground in working capital terms. Basically means this high profitability we've had in the last year or two doesn't come at the expense of them liquidating out of the working capital within their business. And then focusing also on the investing needs that the company has had from investing level, see that the vast majority of reinvestment has actually been acquisitions, which is consistent with what we were seeing and expecting from the company's presentation, with the very fragmented lumber industry as a whole and their expectations of being able to expand their production by buying up some more space, particularly within the US Southeast portion of the lumber industry. All right, now focusing in on the relationship between the lumber prices and the actual revenues of Interfor specifically, you can see in this graph that I have right here in the blue area, we have the 90-day average lumber price. So the lumber price on average within a specific quarter, and then the quarterly revenue of Interfor going back for the last 5 years. You can see that there's a very, very close relationship between the two. The average lumber price within 1 quarter obviously very directly relates to the revenues of a lumber producer. That should be obvious. In fact, you can see that there's actually really about a 1 quarter offset between when the revenue tends to have the largest spike up relative to the growth rate and the actual lumber price itself. So approximately a 1 quarter offset, but that's basically what you would see. This shouldn't really be surprising information. This should actually be exactly what you would expect to see. Anything different from that would be the real surprise. Now, the thing about lumber prices in particular is that they're actually very, very volatile. Zooming out from just a 5-year chart, which we were just looking at, this is the lumber prices going back all the way to 1973 in the blue area. You'll see lots of volatility and zigzags within the movements there, and lots of holding patterns too. You can see that it tends to spike up to some high levels, and then it might dawdle below that high level for quite a long time, decades even, before then spiking up to some new high point. And I kind of want to point that out because it can kind of seem while you're in the middle of these kind of lull periods, like it's not necessarily going anywhere until eventually it does have one of these large spike up moments that puts it at such a high level dramatically comparative to any of the previous past prices, and then it might dawdle for a long time again. And I point that out because it's almost like we're going through a similar time frame right now. Who's to say whether or not that's actually what's going to happen? I'm not pretending like I have some special crystal ball that allows me to define lumber prices. I'm just going to rely on this kind of longer term history and assume that the future is going to look something like the past in terms of this kind of longer term trend, as long as a few key assumptions can be put in place here. Now, we buy things in terms of nominal dollars, and the governments of the world tend to like to inflate the overall amount of those dollars. So the few basic assumptions that I'm going to rely on here is that the governments are going to keep printing more money, and therefore inflation is going to keep occurring in terms of nominal prices of things like lumber, key commodities that go into main objects. Now, the other key assumption that has to go along with that is that you have to assume that the demand for that product is at least going to stay roughly similar. Some of those slides within that presentation, hopefully, I think could actually help make the case that demand would actually maybe be elevated within the next decade relative to the past decade. But with, like I said, the aging of the U.S. housing stock, that might create even more demand for lumber, which could increase the prices. The only thing that counteracts this is that there's always technological change that can occur. Replacement materials could be defined, or different ways of using materials that already exist could be come up with that could replace some of the ways we use lumber today. So I'm effectively assuming that no real amounts of change are going to happen within lumber prices, and I'm effectively assuming that there's going to be more dollars with which to purchase the same amount of lumber. I.e., that's going to lead to an increase in lumber prices over time. At which point, the only argument is then, at what rate are we going to argue that lumber prices are going to grow, and from what point are we going to grow them? Because obviously, with the huge volatility in lumber prices, there's a huge basing problem to have with lumber prices. So what I've done here is this red line is the 10-year rolling average of the lumber prices within. You can see it does a pretty good job of smoothing out this huge volatility that we have within the lumber prices. It doesn't really necessarily do too much of a downward divot, though it does occasionally move downward for periods of time. We see like about a decade where it actually seems to go back down for some period of time, and then it's started to take off a little bit in the last few couple years or so. It's currently hovering a little bit below 400 US dollars per board foot. And then also in the yellow line here, you can see this is the rolling 10-year CAGR of that smoothed out normalized price. So I took a normalized lumber price, and then I said, okay, well, on average at any given point within this line, what is the typical likely CAGR over a 10-year time frame for that? And if you take an average of all of these rolling 10-year CAGR numbers, the average ends up being about 2.6, which is maybe somewhere around here or so, something like that. So from my perspective, I think it's pretty reasonable to assume, based off of past lumber prices and the past trajectory of lumber prices, that at a pretty conservative basis, we can assume that the 10-year average lumber price is likely to increase at about 2.6% per year for the next 10 years. Again, that being a 10-year average increasing at a certain rate. Which means who knows what the actual lumber price will be at the other end. It could be at the higher end of one of its more volatile spikes, or it could be at the lower end. It could be at some low end of some decade-long dawdling within the overall price. But I'm going to assume that the average overall within that term is going to increase at approximately that relatively basic rate. So that covers our assumptions for lumber prices, but then there's the other part of the equation that we have to answer, which is production. We need lumber prices, and then lumber prices multiplied by the amount of lumber sold, and that's going to get us to our revenues. Now here, in this particular graph, I have Interfor revenues in red, and also Interfor production in blue. So you can see that there's a very, very close relationship between the increases in the Interfor production and the overall revenues that the company gets in that particular year. It's actually very, very close. In some ways, even closer than the lumber prices. It's interesting to see that we have such a strong relationship. And then here's the expected production for 2023 that they already have in place. And then that also doesn't go to include the other production targets that we had talked about here in this production slide right here. So here's the 4.5 billion expected in 2023, but then there's the 5.1 billion expected in 2025, and then the 7 billion potentially expected in 2027. So in this relatively simple table right here, I combined basically all the information from these graphs. We have the lumber price at the end of each of the years right here, that same normalized 10-year average price that I had in the graph that I showed, the Interfor production that we had in the other graph, and then the Interfor revenues that we had right here. I'm basically just going to create a relatively simple set of assumptions for my bear, base, and bull case. I'm going to assume that the normalized price, the normalized 10-year average price of lumber is going to grow at an average 2.6% per year. And that's going to be my base case assumption for my valuation. For a bull case assumption, I'm going to assume that it could theoretically grow at twice that rate. It could grow at about 5% per year, which would put it at the upper end of the range that we saw within our historical time frame. But as we had said within the PowerPoint presentation, there's some reasons to believe that demand could actually increase over the next few years or so. So for my bull case, I'm going to put that there. In my bear case, we're going to assume that lumber prices potentially don't grow at all. That was also at the other end of the likelihood range within our historical range of typical growth rates. We didn't really see a time frame for 10 years where it didn't grow exactly overall, but that's a potentiality I think is equally on par with it possibly being twice as fast. So the point is I'm going to have 0% be my bear case potential growth rate for the 10-year average. Then I assigned probabilities for each of these outcomes. There's nothing magical to the probabilities I assigned here. We're just making up what we think is likely to happen, and then we're allowing the statistics to give us our expected case. So I'm assuming about a 50% amount of probability for the base case and 25% for each of the bear and bull cases. Then for Interfor production, our bear case, we're going to have that 4.5 target that we have for this year, and we're going to assume that means that for the next 9 years beyond that, they don't grow production any further. And I'm assuming that that's actually not that likely to happen, especially given the production targets that they have in place and the pretty good case that they laid out for how they're going to achieve those targets. I don't think that's super likely that they wouldn't then. So I'm only assigning it a 10% chance of happening. Then there's the 5.1 billion board feet target that they had for 2025. I think it's a pretty reasonable conservative case assumption to assume that that's maybe where they get to, especially since they managed to lay out very specific projects for how they're going to get there, and I'm assigning a 55% probability for that. Then there was the more bullish targets that they had for getting to by 2027 of 7 billion board feet. They didn't lay out specifically how they intend to get there, just giving us kind of some vague M&A potentialities that they have in front of them for how they're going to achieve that, so, which I think are likely to happen. But maybe not even by 2027. Maybe it takes them a year or two longer or something to get there. And even though, like I said, for this valuation, these numbers are for 2032. So really, I'm giving them lots of time to get there. But we're going to assign a 35% probability for that. So then if I combine the two sets of probabilities that I have right here using Bayesian priors information, that gets us to a set of revenue outcomes to which I then took the median, the first quartile, and the third quartile of the outcomes. The median case revenue that we get in US dollars, because most of this was done in Canadian dollars, or wait, my bad, I have that reversed. This is in Canadian dollars because all of these were done in US dollars. The median case outcome ends up being about 4 billion versus the first quartile outcome being about 3.7 billion, and then the third quartile outcome being about 4.8 billion. On an expected basis, we see about 4 billion or so. And here's what those revenue assumptions effectively look like in time series. You can see the cumulative growth cases right here. With the bull case, the revenues do eventually reach a peak in the last few years, coming in at total cumulative growth of about 5% or so, while the base case has about still almost 15% decline from last year's revenues overall, reaching its low point in 2026 or 2027 or something like that. With the bear case also reaching low kind of the same time frame, but only managing to make it all the way up to just under 20% below the previous peak of revenues from last year. And then in terms of incremental growth per year, you can see right here the losses of a few hundred million or so per year, down to maybe 1 million per year, and then eventually getting into growth of a few million per year for the last few years of the growth timeframe. And in terms of what we're doing with the operating margins, as we had kind of seen, the margins of Interfor over the historical timeframe had shown them as being relatively strong compared to their industry. With the industry margins ending up being something in the low, or not low, the high single digit range over the longer term time frame. So what we're kind of doing with the margins is seeing some potential operating margin losses in the short term, but probably just very low margins, and then eventually reaching to some peak highs of operating margins well in excess of the industrial average, as we kind of have seen with their historical past, and then eventually moving towards a terminal rate that puts them in line with their industrial expectation. And then we put capital investment assumptions in place that are consistent both with the expectations given to us within that presentation, but also within the longer term expectations we have given their industry. Will we expect net of total depreciation and depletion, overall capital investment to be negative to 100 or a few hundred over the next few years or so before moving into positive 100 or so million investment per year into the kind of the terminal distance. That gets us to returns on invested capital, also spiking up very similar to the operating margins before moving down into kind of a rate that's consistent with their overall cost of capital in the terminal year, which gets us free cash flow somewhere in the range probably between about 100 and 200 million or so in the terminal year, though with some potentiality for free cash flows to potentially be negative into perpetuity, though extremely unlikely. And with all of these assumptions in place, with a terminal implied multiple in the low kind of teens range as well, that gets us our fair value distribution as we have right here, as well as our expected returns distribution. So fair value distribution, pretty likely range in this kind of like 20s, it seems like, with lots of potentialities for a much lower number and worse circumstances, though with some potentiality for higher values as well. Expected return seems very, very likely in the teens, the most common outcome being between 14 and 18%, though there is a non-zero couple percentage chance that the company is worthless under a few circumstances as well. Scrolling up, you can see the more traditional expected case of the valuation as we have right here, with our current fair value expected value of $22.72 per share, giving us about 35% expected upside. Puts it at 28% within that value distribution that we saw below, expected 10-year returns of 13.7% per year. Looking very, very good. This is converted into USD comparative to the actual financial metrics up here, which are in Canadian dollars. It's worth making sure that you have that straight. If you enjoyed this valuation, please like the video to help me with the YouTube algorithm, and subscribe to the channel if you're not already. That way you get notifications whenever we release content like this, and join the Discord, the free Discord. The link is in the description below. I hope you guys enjoyed this overview of Interfor Forestry. As I mentioned at the start, it is a part of my portfolio currently, so full disclosure on my interest in that. And as you can see, I'm very, very happy with the valuation where it currently stands, and I'll probably be still buying it moving into the future. All right, I'll catch you all in the next one.